This is For Advisors by Advisors. I'm your host, Evan J. Mayer, and today we have a very special guest, Mr. Norman Darden.
Applause. I like it.
Well, you came with the applause, but the applause left, so we had to create it. How you doing?
Fine.
Good.
Thanks for having me.
Of course. Norman is a portfolio manager and analyst with Flippin, Bruce & Porter, which recently, over the last couple of years, got purchased by Cantor Fitzgerald. That was about 2 years ago, right?
A year and a half.
Year and a half ago. And Norman started with Flippin, Bruce & Porter in 1999. And prior to that, he was with AmSouth Bank from 87 to 99. So basically, your entire career, two stops.
2 stops.
Yeah.
2 stops.
And you were more on the trust side at AmSouth.
Exactly.
And then you joined Flippin in 99.
Right.
Talk a little bit about, you're a portfolio manager. That's what you do. Day in and day out, you're looking at positions for clients, doing what you're doing. How did you go from AmSouth to Flippin? How did that transpire?
It is a good question. AmSouth is now part of Regions. So the Regions name is still there, but AmSouth merged with another Alabama-based bank. And I started looking for another opportunity when AmSouth began to merge with other firms. And we had been a value-oriented portfolio management shop 100%. And that's the way the firm was started in the 70s. And the trust department, AmSouth, was 100% value. Think about the 1990s. 100% value means you're leaving a lot of money on the table for your clients because growth was going through the roof. And the bank merged with a growth shop, another trust department that all they did was growth. And I just had my roots in value, loved trying to uncover value. And I could see that with this merger, the bank was going to be going a different direction. And we were going to be taking clients' money and moving them into growth assets. If I was the management, I would have done the same thing, but it wasn't something I was interested in.
And how did Flippin come after you? Did you find them?
We had a fellow that I had worked with before who had moved the year before I did from the bank to Flippin. And so there was a mutual connection there. And it was a great opportunity to go to work for a small employee-owned firm that focused solely on value management.
And did you join the portfolio management team immediately upon joining them?
I did.
Got it.
So part of my work at the bank in the trust department, we really did emphasize, the management there emphasized CFA and getting that chartered financial analyst designation for basically everybody on the staff. So I did that in the early 90s. I'm an old guy, and thankfully I put that behind me. I think it's very difficult to get the CFA today, probably much more difficult than it was when I did it. But it was a great feather in my cap. And it gave me opportunities to look around and find other places to go. And I had some choices to choose from and loved the people at Flippin and loved the environment in Virginia, small town Virginia.
Now, was all 3 of the founders, were they part of the committee at that time?
Yes.
And how many total people were on the committee when you first joined?
9, okay. 8 or 9.
8 or 9.
Yes.
And how many are part of the committee today?
5.
5. So it's switched pretty significant.
It's changed over time, of course, and we really have a good core group, and we've all been together. I'm the new guy, is what we say all the time, because was the last hire.
Out of the 5, you still are?
That's fine. I'm the new guy.
Oh, really? Yeah. Okay. So they never hired anybody else since 99 that joined the...
They did, but those are some of the people that have left.
Got it. Okay. So you're the longest standing new guy.
Correct. Correct.
Very cool. I met Norman back in SunTrust days before I gone independent. I was using more SMA managers back then, but I was still managing certain things on discretion. And one of the nice things of what you did was, and you got introduced at a meeting, we got to actually listen to the strategy. And what I liked about the strategy was that it wasn't a buy right strategy. It was a way to generate additional income through call premium. And you were able to do that with picking good value stocks, but you were able to do that without making it a buy right by only doing that probably on a third of the portfolio at a time. And so what that allowed your portfolio to do was actually compete with the market, even though it wasn't necessarily supposed to beat the market or was supposed to generate 5% income. That was kind of the cash flow mantra. You kept up with the Russell 1000 value. And today you're still doing that.
We're doing the same thing. And I think that you hit on a really important aspect of what we do at Cantor, FBP. And that is we try to capture as much of the upside in the portfolio as we can, as we think is wise, and we only layer those calls on when the stocks, individual stocks, appear to be approaching what we think they're worth. So that's really where we focus on that call premium, is on just that segment of the portfolio, and it allows the rest of the portfolio to participate with the market.
And do you ever write a call immediately upon a purchase of a stock, or it's very rare?
Very rare.
Okay.
Very rare.
You've done it.
We've done it, but it's only, honestly, it's only happened after we get a really, really sharp up move in a stock that's sort of unexpected.
Got it.
And it's happened, I think, twice since we've been running the strategy in 2008, where we buy a stock and shortly thereafter we get some positive news, the valuation expands, the stock moves up rapidly, and we sell a call pretty quickly.
And as far as earnings are, when you know earnings are coming out and your guys are analyzing the stock, you know, how close before or after earnings do you buy a stock?
We pay attention to that, but it's not really something we focus on because we are long-term investors. We understand that if we buy a stock at 21 on one day and then 3 weeks later it's at 19 because they've had some earnings hiccup in the short run, we don't really care. I hate to say it that way, but we really do focus on what we think it's worth over time. And in the long run, we think the stock in this example is worth 32. So we'll use that as an opportunity to buy more in most cases.
So like you bought a stock like 2 days or 3 days before earnings?
Not that I recall.
Yeah.
Oftentimes we get opportunities around those earnings calls where we have an opportunity created by the earnings shortfall. And that's really probably more common. That gets us interested in a stock. We seldom have what we would say would be like inside information or very strong views that a stock will exceed earnings and we want to get in before that. That's pretty rare for us.
And we talked a little bit about this before the call, but with Cantor Fitzgerald coming in and obviously a bigger firm mentality coming into the small firm that you guys were, you had mentioned like you guys are still running the portfolio as is if you were just flipping Bruce and Porter. Is that accurate?
Absolutely. Yes. And that's one of the nice things about this partnership is we still feel like we're a small company. We still feel like we're a small shop because they've left us alone. That we keep our offices in Virginia where there are 12 people, 5 of us on the investment team. There's no New York City investment committee at Cantor telling us which stocks to buy or which sectors to override or how to implement our call discipline. We're doing that exactly like we always have.
Now, one of the things that I always liked about you guys was that you were small, and the concept of if I wanted to speak to you on the management committee, I could get you. And getting into firms is a tough thing to do, right? Because at the end of the day, they're looking at not only your performance, which you guys easily speak to that, but in this business, there's a lot of connections, knowing people and going through their investment process and getting on platforms. You guys, obviously, initially, you were just kind of managing local money, right? And then you started expanding into the SMAs. What year did you guys start going outside of kind of home?
Well, with our EDP strategy, what you're talking about with the covered call option writing, we started it in 2008. We seeded it with our own money. And in 2011, so 3 years after that, we felt like we had something that we could market. And so we initially started approaching some partners that we thought we might be able to make some agreements with. Mm-hmm. It took 3 years. It took 3 years to get that through the process. And part of it was our size, being a small manager, and the strategy was relatively new. That's something that's a concern to these due diligence teams, these analysts. And
so SunTrust was not one of the first, but
it was the first.
Oh, it was the first.
Yes.
So that was a huge win for you guys.
That was a huge win.
And now, roughly, what's your AUM with the strategy?
I think AUM as a firm is about $800 million now with Cantor.
Yep.
We're approaching $4 billion.
Yes, of course.
With the Cantor Fitzgerald Investment Advisors.
But about $800 million.
800 in the Flippin subsidiary.
Got it. Okay. And, M&A in the space has been huge. We're seeing SMAs and mutual funds get gobbled up kind of by the big firms. And that's a good thing in a lot of ways because things like marketing and access get out there for you. What does the future look like in acquisitions? Do you think that's just going to continue to snowball?
I think so. I do know scale is very important. Even today, in some conversations with some other advisors, there was discussion about size and availability and other strategies, and I do think that is very, very important. Folks like you and advisors like to be able to have one phone call they can make for multiple services and multiple products. And so I do think that's the wave of the future. But at the same time, new firms are starting every day, and maybe they have a slightly better way of doing what they do and generate good results. And so there could be opportunities for entrepreneurs and other strategies to arise, and maybe that's who gets acquired down the road.
Now, value stocks have had a significant run this year, and many people still believe there's still a really long way to go in the concept that we're either in a recession or heading to a recession, whenever the official term comes out that we're in a recession. Value stocks, specifically when rates are going down and the yields are good and you're getting safety in these companies, I mean, you still think there's a long stretch for value stocks?
We do. And again, what we focus on most of all is cash flow. So we're looking for good dividend payers, companies that can grow that dividend over time. So we're not stretching for absolute yield. We're not just buying utility stocks or REITs, for example. So that gives us we believe, the flexibility to buy a fully diversified portfolio. So we're going to have exposure across all sectors, but where we focus is on the value part of every sector. So we've got technology stocks that aren't typically known as value stocks, but we've got a number of technology stocks in the portfolio, but they would tend to be the ones with the higher yield and the lower valuations. And we went through a multi-year period, as you all know, that saw value really suffer relative to growth.
Yeah.
And that's just one of those cycles that extended longer, I think, than any of us thought. Will we have a really, really long value outperformance to offset that? Who knows? The jury is out. But I would say that it would not surprise me at all to see that rotation back to value last for some time.
So talk to me about what's a day in the life of Norman in the office, okay? I know you have client events. Sometimes you have to go speak to, you have to visit clients that are out. But, Norman in the office today, it's a regular Tuesday. He's walking in. What does his day look like?
So 9 a.m. is our weekly meeting where we talk about stocks. We always go over our targets. So we spend a lot of time focused on what we think the companies that we own and the companies that we're interested in.
That's not daily, right? That's a weekly meeting?
That's a weekly call, but it is on Tuesday, and you asked me to describe my typical Tuesday. So on Tuesday mornings, we have that call. And when COVID hit, we started doing that virtually, even though it's a small group. And we still do it virtually, even though in a lot of cases we're in the same office. But it works really well. We have good interchange, good exchanges there about what we think companies are worth and where we think we might want to add money. So that's basically the morning. And let's say we decided then we're going to buy some more of MTB. That's a stock that's down today. And so we decide we're going to buy some more of that. Then we'll put a block together and we'll do the trade. And so I'm involved in building that. Maybe you call, or maybe another advisor calls and answer a question about the quarter that we just finished. Then basically the screen is up, you're watching the portfolio. Maybe we decide we've got to run in another stock. I don't know, we'll say Merck, and let's decide we're going to sell a call in Merck because that stock has had a nice move, and we put together another block and we sell calls in Merck. So really the day is spent focused on the portfolio, reading analyst reports on stocks in the portfolio, and then having exchanges with each other about what we're reading and what we're feeling and what we're seeing.
Are you all like kind of assigned different sectors where like you focus on a sector and somebody else on the group focuses on a sector?
We are, but I would say we're all generalists in reality. So we're all looking at every stock in the portfolio. And when we put our target prices on stocks and try to ascertain the true value, what we think it's worth, we don't have a lead analyst who takes that role and determines the value for the firm for a sector. We're all doing that together.
And what TV channel's on? Is it CNBC? Is it Bloomberg? Is it
CNBC? Now, it's not in our offices. We have one central location where CNBC is on. And
got it.
I think that's a double-edged sword in a lot of ways.
Yeah.
It's fascinating, and clients, in most cases, enjoy watching the financial news and trying to figure out where markets are headed. But it also creates emotions. And in reality, we try to take advantage of that as a value investor because we're trying to buy stocks that are beaten up, that have gone down in price. A portfolio today is less than 10 times earnings. We think there's good value there. But it creates opportunities, which is a good thing, but it also generates so much emotion that in markets like we've had this year, we hadn't seen much of it because we've done well and held up pretty well. But clients are concerned, and clients will call, and clients will be emotional. And trying to talk people off the ledge is part of what we do. And that, I would say,
You got to talk more. Your clients or advisors,
exactly.
our audience.
Yep.
Yeah.
Yeah, exactly.
And of the 5 people on there, is there a lead portfolio manager? And when I say that, obviously having an odd number on there, if there's, 2 people agree and 2 people, disagree, does that third person, is that the tiebreaker?
We usually have more of a consensus, to be honest. And so we don't find ourselves 3-2 very often. In fact, if we found ourselves at 3-2, we probably wouldn't do whatever we were contemplating doing. We do look for a little more consensus building.
But I can't believe on every stock that you want to buy, there's a consensus. Like, meaning maybe there's a consensus if you move forward, but have you had like really strong conviction and they just didn't see what you saw?
Not usually. Again, we're looking at the same numbers, we're looking at the same companies, reading the same reports. And so if somebody can't be convinced, then maybe that's a good reason to pause.
Are there ever biases? Is there somebody like, even yourself, that like there's that one company, it gotten burned 10 years ago on it, or there's thoughts about the management on it and like everybody else likes it and you just don't?
I don't know about specific company biases, but I think in general, when we have our meetings, we know which one of us will bring up too much debt in the balance sheet. So there's a hot button that one member of the team might have. We know which one of us will have targets that are higher than the rest of us because they're just a little more optimistic and a little more looking at the upside than the rest of us. And so we end up with this consensus with our targets that blends all that together and comes up, we think, to a nice place. And we use those targets a lot because those targets really do drive the selling of call options because we want to capture the upside, right? We mentioned that. And so if we think a stock is worth 80, when it gets to 75, if we're approaching that $80 value, $80 might be a really good strike price to sell a call.
The excitement of when you pick a winner and you're the one that brings it to the table, like, obviously I would think there's ego in everything. Like if you play golf and you shoot way below your handicap that day, you feel pretty darn good. Same thing, I'm guessing, when you pick up one and it ends up being a winner, you bring it to the table.
I think so, but because we're doing, again, all this work as a group, there really is not a situation where, very often, where you feel like this is my stock and that is his stock, and I hope mine does better than his. We don't really have that kind of environment and that kind of situation.
Do you think that some of that has to do with the stocks that, obviously we can give the politically correct answer that we just have such cohesion, but I would guess like high beta portfolios, there are people maybe on those teams that are like, because again, your growth percentage on Hanes underwear, if it goes up 20% tomorrow, there's some luck, I guess, to the overall thought there.
You may be right. It may be the style that we run just lends itself to that type of consensus building approach. We're not looking to hit home runs.
Yeah.
We're looking to find stocks that are discounted from where they usually trade, and we buy them and we wait. And if they meet expectations and grow and show progress in earnings and book value and sales, then we'll have an opportunity to sell a call and move out of that stock later because it will approach that full value that we were looking for.
Is there an analyst or two that you just love to follow? Like when you're following one of your stocks, you really just appreciate what they put together?
There are probably a handful out there that have good reputations, but we try to be independent thinkers. A big part of our nature as a value investor is to go against the grain a little bit. So in our minds, a lot of Wall Street research, smart people, great research, in many cases spot on, but it tends to be more short-term focused than we are. So we tend to discount some of that Wall Street research and focus on maybe the longer-term models that are out there that might show good value in a stock, even though the analysts may not even be recommending it today.
Meaning like analysts are focusing for how that stock could increase over the next year
quarter.
Quarter.
Yes.
Yeah.
Yeah.
So probably not a huge bearing as far as that goes. And percentage-wise, you do like a stock. Is there a formula on what percentages you'll put into an initial buy or how high of a percentage you may increase on a stock?
There's really no hard and fast rule, but we tend to establish almost all of our positions 1 to 1.5%. Doesn't make sense to really go any lower than that because you're not really going to get the benefit in the portfolio. And going higher than that can tend to just increase your risk that you've bought at an opportune time. So we tend to start at 1%. And then if we get weakness, and we've had this happen, you've seen it in the portfolio, we use that as an opportunity to increase the weight. Ideally, and this happens a lot, we end up buying another 1% and then another 1%, and we have a 3% weight. And then we get a nice rally in the stock, and then it's 3.5 to 4%, and we start looking to reduce that weighting.
So if anything goes above 5, you're starting to trim or look to find a way to trim.
Yeah, and really probably that number's more like 4.5.
Got it.
At this point. And we own about 50 stocks in the portfolio.
Let's talk about moving. Advisors are constantly looking to leave. Obviously, if an advisor goes RIA or independent, it's a lot easier per se to work with you because the underwriting of the existing firm is going to be less, or they'll allow for what they call third-party management. But I'm guessing when an advisor leaves and goes to a different firm, there's obviously a fear out there of, are we on that platform and can we get on that platform? Talk a little bit about that.
We hadn't had too much of that because, as I mentioned earlier, the strategy got on its first platform in 2014, 2015. So it's not like this equity and dividend plus strategy has decades of advisors coming and going. So it's limited experience there personally for us. But we have found that having the connection with Cantor allows us to be a little more portable and allows advisors, if they have moved, to find a spot where they can actually use us if they would like to.
And so have you already seen the doors kind of open over the last year and a half since you've been with Cantor to get onto more platforms?
Yes.
Okay, great. And how many advisors currently are utilizing the SMA strategy? Any idea?
That is a really good question. I have no idea. I could ballpark just by, I know how many accounts we have.
Yep.
120, 100 maybe.
That's great. But see, I like that. I mean, obviously, the goal is always to get
It's
bigger.
not thousands. Right?
right. But I like that because there's the concept of being able to reach you and get a hold of you on one ring or two rings is pretty good. And you've always been great, by the way. So kudos and shout out to you guys. Where do you?
Well, I will say this.
Yep.
I firmly believe in answering my phone, and I firmly believe in responding to emails. And I would tell any advisor in this business, if you're too busy to take calls or you're too busy to return emails, then something is off somewhere, because responding to your clients, responding to questions, when clients hire you, they're trusting you to help them with their future and with their investments. And anytime they call, they have a reason, and they have needs or transfers or withdrawals, whatever. And preaching to the choir with you, I know, but I do believe very strongly that one of the best ways you can retain clients and grow your business is answering your phone and returning emails and responding in a timely manner.
Well, we're your clients. And in essence, if you're not calling your clients back right away, then your service model is hurting. And, I will say there are a lot of firms out there where the wholesaler mandates that they speak to you prior, and you're like, well, I want to speak to the money manager. And the nice thing about you is that you can get you directly, which is neat. It's a great thing. I hope you don't change too much if you get too big. So let's talk a little bit about the macro economy. I know you're not an economist, you're a portfolio manager, and that the focus is on finding value in today's market. As you and your team of 5 are looking out, the interest rates have increased dramatically.
Right.
It doesn't impact M2 right away. There's a process to that and a lag to that. My contention early on was that the Fed was not moving quick enough in January, February, March. And now I think they moved too quick.
They solved that problem, I guess.
Or solved that problem. And now they've gone so quick in such a short period of time. And I know they're focused on 80 and 81 and 82 and 83 and the Paul Volcker era of just kill it quick. But do you guys believe what they've done so far is probably enough and they should pause a little bit? Or are you guys more into the camp that they should just keep going until they start to see the inflation numbers drop?
I would say that in this situation we're in today, the goal is 2% inflation, and we are way, way above that. So the Fed has said we really need to work hard to get that down, and I think we have to take them at their word. So I think there's more to come, and I think the Fed will probably continue to be fairly aggressive. Now, there are many people out there who say inflation has already peaked, and it probably has. But we believe that going from 8 to 2 is not realistic in the short run. It's not realistic in a year or two. Who knows when we can really get to 2. So if we think that the Fed is going to drive it to 2% with increases for the next several years, that's probably too aggressive. We think what will likely happen is the Fed will end up being comfortable at 4.5% inflation, maybe 5. That sounds high, but maybe that's what ends up happening, at least as a step down. And so we do know that that is pressure on the economy, and the Fed has said we're doing this, and it's going to cause pain to the economy. And they're doing all they can to try to balance the tightrope and not go into a recession, but also get inflation under control. It's very difficult to do. So we think they'll probably err, and we will hit that recessionary period this year. If not now, then later this year or early next year. Our hope is it's a shallow recession, and that it does not do damage to the underlying economy like we saw in 2008, 2009, where the core banking system was really, really challenged and stressed.
And that looks strong, though.
I don't think we'll get there. I really don't. And we've got really good employment numbers continuing. Which
isn't that somewhat a problem, though? You know,
if they're trying to slow things down, that is a problem. So again, double-edged sword is out there. So it's complicated, and I would say, Evan, that we believe that if we do get a mild recession, that the market has probably priced a lot of that through its mechanisms today. Does it mean we've already bottomed? Who knows? Does it mean we bottom in a month or a quarter or 2 quarters? We don't know. But we do know that we believe we're closer to bottoming than we have been in a long time, and we will start positioning the portfolio at some point to look through that. And we know the market will do that as well. So that stocks will move well before the economy really shows signs of improving.
So a 20% drop to you is highly unlikely?
From here?
Yeah.
Yes.
It's good to hear.
Yeah.
It's funny, my contention was June, we hit that low, and then we saw inflation peaking, is fair to say, and then seeing what happened last month, obviously, I think threw us all for a loop that it actually went higher month over month and significantly higher month over month. And so you're probably right in the concept of them continuing to raise rates. I guess my fear is if they raise rates up this quick, and it's such an unprecedented level of 75 basis point increases month after month after month, that how does that not put us into a recession that's at least a medium recession, middle of the road. And not mild, I
can't argue against that necessarily, other than to say they don't want that. and
to say that nothing's been normal the last 3 years anyway.
True. That's very true.
So it's like, if it sounds like that should happen, then it's probably not going to happen that way. So, the show is called For Advisors by Advisors. The concept of the show is to basically give advice out there to advisors that maybe could improve their practice or improve them. You've met with a lot of financial advisors in your day. Obviously, you're coming at it through a different angle on the portfolio management side, but in a lot of ways you are an advisor. You're just an advisor to advisors. So I guess my question to you would be, what would be the biggest piece of advice that you could give to financial advisors during this period of time?
Well, I'll go back to what I said earlier about being responsive and returning calls, returning emails, answering your phone. And I think at its core, a big part of that is humility. It's just is coming across as someone who is here to serve and here to help. And I believe the most successful advisors have that attitude. And so I would say humility and try to admit mistakes if there are mistakes when they happen. And I think that builds trust, and it's reality. We all make mistakes because we're human. So I would say that would be a really good character trait to aim for. One way you can show that is by being responsive and answering the phones and returning emails.
And one last plug for Flippin. I mean, you guys do things differently than other SMAs. What makes you different than every other SMA out there?
Well, it really is the focus on cash flow and the focus on the way we selectively sell covered calls to generate extra cash flow for the client. We know cash flow is huge for retirees. It's huge for institutions, But we think it's also important, even for younger investors, to have sort of this value cash flow part of their portfolio, because it just offsets other segments of the market. And we know, we've talked about this, value did not do very well relative to growth from 2015 through this first quarter, I guess. Yeah. But there's a part and there's a place for value in, we believe, in every portfolio. And so the fact that we've got that core emphasis on undervalued securities, and we apply that covered cost sell discipline on top of that selectively, gives it a unique approach, and we're proud of it.
Awesome. Norman, it was great having you in. If anybody wants to get a hold of you or the strategy,
I guess I need to answer my phone and my
yeah. Or they can find you on LinkedIn, maybe, right?
They can find me on LinkedIn. Yeah.
All right, sounds good.
They can.
Well, thanks again for coming in. It was a pleasure, Norman.
Thank you.
For the advisors out there, hopefully you enjoyed this. I think conceptually speaking, we all believe we can manage money. Being able to run covered call strategies and things along those lines can be time sensitive, and sometimes having the ability of having a good management team and a management team that always agrees, which is, I want to dive deeper into that one day, is an awesome thing. And the strategies are good. I'm not telling everybody do their due diligence, but having good management that is responsive to you and your clients is a phenomenal thing. So thanks again, and hopefully you guys enjoyed today.
Thanks a lot.